Have you noticed something unusual in the markets lately? Investors aren't chasing the next big thing like they used to. In fact, US investors are suddenly stepping back from risk. The reasons go far deeper than a simple market dip. Today, we break down why US investors stopped taking risks, what's driving their fear, and what it means for the economy, innovation, and your money. In the past few years, investors rode wave after wave of growth, from mega-cap technology stocks to emerging sectors like AI and crypto, enjoying some of the highest returns in a generation. But a recent Natixis survey shows that US investors have dialed back expected returns by over 20%. Nearly 3/4 now fear rising market volatility and global instability. So what's causing this shift? The first major factor is inflation and economic uncertainty. Even though inflation has eased from its peak, only about 1 in 4 investors believe it's truly behind us. More than 60% still cite it as their top financial worry. This fear eats into confidence and makes risky assets much less appealing. Then there's geopolitical tension and policy uncertainty. Trade disputes, new tariffs, and shifting tax policy create a murky forecast. Even well-educated investors struggle to model future returns. When the rules of the game keep changing, investors naturally favor safety over speculation. Another powerful trend is the rise in US Treasury yields. This has refocused capital toward bonds and away from equities. Higher yields act like a magnet for risk-averse money. Suddenly, long-term government debt looks more attractive compared to volatile stocks. We're also seeing real behavior changes in where money flows. Broad US equity index funds are attracting massive inflows, while high beta and speculative sectors like crypto or leveraged ETFs are bleeding capital. This isn't a blip. It's a shift in investment psychology. Psychologists call this the flight to quality phenomenon. Investors sell perceived risky assets and move into safer, more liquid options, often government bonds and cash. When markets are uncertain, fear overrides greed. Investors seek protection first, performance second. Now here's where it gets even more interesting. This change isn't universal. Some months show risk appetite bouncing back briefly, only to retreat again, like a tug of war between optimism and fear. Surveys from S&P Global show US investor risk appetite fell to multi-month lows after tariff headlines, pointing to the fact that one news cycle can flip sentiment dramatically. So what does this mean for you? First, markets are not just random. They reflect deep structural shifts, macroeconomic stress, geopolitical risk, monetary policy, and human psychology. Second, risk-off behavior doesn't necessarily spell disaster. Instead, it signals a broad reconsideration of what safe growth means in a world of slow growth and persistent uncertainty. Before you scroll away, think about this. Have you changed your own investment behavior because of fear? Are you underweight risk because headlines scare you, or because data actually supports caution? Drop your thoughts in the comments. I want to hear how this trend is affecting your strategy. And if you found this breakdown helpful, don't forget to like, subscribe, and hit the bell so you never miss our deep dives into market psychology, investing trends, and economic truth beyond the headlines. Thanks for watching. See you in the next video.